Imagine waking up one morning to headlines announcing that some of the world's largest financial institutions were collapsing. Banks that had stood for more than a century were suddenly on the edge of bankruptcy. Families were losing their homes. Millions of people were losing their jobs. Investors watched years of savings disappear in a matter of days. It sounds like something out of a disaster movie. But this wasn't fiction. It happened in 2008. Today, we're going to explore one of the most devastating financial crises in modern history. But this isn't just the story of banks or governments. It's a story about human behavior. It's about what happens when confidence turns into overconfidence, when opportunity turns into greed, and when millions of people begin believing that prices can only move in one direction. To understand the collapse, we need to go back several years before the crisis. In the early 2000s, the United States was experiencing a housing boom. Buying a home wasn't just considered part of the American dream. It was seen as one of the safest financial decisions anyone could make. House prices kept rising, year after year. People became convinced that real estate could never lose value. If your house was worth more every year, why not buy a bigger one? Why not purchase a second property? Why not borrow more money while interest rates were low? Banks loved this idea. The more loans they approved, the more money they earned. For years, banks had been careful about who received a mortgage. Borrowers usually needed stable jobs, good credit scores, and enough income to repay their loans. But something changed. Competition between banks became fierce. Every bank wanted to lend more money than the others. Gradually, lending standards became weaker. People with poor credit histories started receiving mortgages. Some borrowers had little income, some had almost no savings. Others could barely afford the monthly payments from the very beginning. Yet the loans kept coming. Why? Because almost everyone believed one simple idea. If house prices keep rising, everything will be fine. That belief became the foundation of the biggest housing bubble in modern history. But there was another problem hidden beneath the surface. Banks didn't keep many of these risky mortgages. Instead, they bundled thousands of home loans together into complex financial products and sold them to investors all over the world. Pension funds bought them. Insurance companies bought them. Investment banks bought them. Even institutions that believed they were making safe investments unknowingly became connected to risky mortgages. The danger wasn't disappearing. It was simply being spread across the global financial system. And because everyone was making money, almost nobody wanted to ask difficult questions. The economy looked strong. The stock market was rising. Banks were reporting record profits. Television programs celebrated successful investors. Financial experts reassured the public that everything was under control. But history has taught us something important. The most dangerous financial bubbles don't look dangerous while they're growing. They look like prosperity, and that illusion would soon come to an end. The first warning signs appeared quietly. Home prices stopped rising. At first, nobody seemed worried. After all, markets move up and down all the time. But this time was different. Millions of homeowners had borrowed more money than they could realistically afford. Their entire financial future depended on one assumption, that their homes would continue increasing in value. When prices began to fall, that assumption collapsed. Suddenly, many homeowners owed more money than their houses were actually worth. Some stopped making their mortgage payments. Others simply walked away from their homes. Foreclosures spread across neighborhoods at an alarming pace. One empty house became 10. 10 became hundreds. Entire communities watched property values collapse almost overnight. For banks, the situation quickly turned into a nightmare. The mortgages they had believed were valuable were no longer generating payments. The financial products built from those mortgages became nearly impossible to sell. No one knew exactly how much they were worth. And when people don't know the value of an asset, fear replaces confidence. Banks stopped trusting each other. Lending between financial institutions slowed dramatically. Credit markets, the lifeblood of the global economy, began to freeze. Then came one of the defining moments of the crisis. On September 15, 2008, Lehman Brothers, one of the largest investment banks in the United States, filed for bankruptcy. The news shocked the world. If a company with more than 150 years of history could collapse, who would be next? Stock markets plunged. Investors rushed to sell. Businesses struggled to borrow money. Companies started cutting costs. Factories reduced production. Thousands of workers were laid off. What had started as a housing problem had become a global financial crisis. The effects reached far beyond Wall Street. Families lost their homes. Small businesses closed their doors. Graduates entered one of the worst job markets in decades. Entire retirement savings disappeared almost overnight. The crisis reminded the world of a painful truth. Financial systems are built on trust. Once that trust disappears, panic spreads faster than almost anything else. Governments and central banks eventually stepped in with emergency rescue programs worth hundreds of billions of dollars. Some people argued those bailouts saved the global economy. Others believed they rewarded the very institutions that had taken excessive risks. The debate continues even today. But one lesson remains impossible to ignore. The 2008 financial crisis wasn't caused by one bad decision. It was created by millions of decisions driven by optimism, easy credit, weak oversight, and the belief that markets would continue rising forever. History has shown us this pattern again and again. Technology changes, financial products become more sophisticated, markets evolve, but human emotions remain remarkably consistent: fear, greed, overconfidence, and the desire to believe that this time is different. Perhaps that's the most valuable lesson the crisis left behind. Economic disasters rarely appear without warning. The warning signs are usually there. The real question is whether we're willing to see them before it's too late.